When gold and silver prices dip, what do? Price dips represent opportunities for gold and silver investors. So why is it so hard for the average investor to do this when gold prices drop? Two words: knowledge and confidence. Smart money uses data, market conditions, and their knowledge to dollar cost average while prices pull back in order to maximize their profits. This video will show you exactly how smart money executes these moves. It's very important that I start off this video with a disclaimer. This is not financial advice. I'm not licensed or authorized to give financial advice. And for heaven's sakes, you as the investor must always own your own results. This is just my personal opinion. Okay, Stackers University, today's video is going to be a little bit of tough love. There's not going to be any cute intros or terrible singing by me. This is about the last 10 days that we've had in the market, where gold started out a little bit over 1950 and dropped all the way down to 1890. If you had the means, meaning you had the extra cash, how did you not buy anything this week? I get a decent number of emails, DMs, questions, etc., and I answer each of those with a lot of details. And the last 10 days is the great example of what I've been preaching, and is actually a microcosm for what we're going to experience during this next bull market and what will be required of you to be a successful investor. So why did so few of you participate in this market pullback? If you watched some of my previous videos or even read the comments, you've heard me say over and over again that I expected gold to pull back to 1920 or even 1880 and silver down to $22 to $24. So you needed to keep some dry powder, as the saying goes. Now, in my last video, ignore the predictions, focus on the conditions, which didn't get a lot of views. I really tried to drive home the idea of ignoring the noise and learning to focus on the conditions and allowing data and research to drive your decisions. This is exactly why I was confident that we were going to have another buying opportunity in this range. It's not about predictions, be it from me or some world-renowned figure, because none of us have crystal balls. This is about positioning and understanding markets. We had a huge run up based on the Russian-Ukrainian war, and we know moves like that eventually come back to where they came from. Like you, I watched gold take off, but I didn't chase the market like many people. I didn't make any purchases. I waited almost a month because I knew the war premium was going to fade. Why? Well, because historically, this is exactly what happens. Again, not a crystal ball, but data, facts, and historical performance. So let's talk about the first indicator I want you to understand. What we just experienced was a normal or healthy chart behavior. It is very typical and in fact healthy to have sideways consolidations and retests, kind of like stray cats you feed. They and the market always come back. Whenever you see sideways action, especially after a run-up, I want you to see that as smart money accumulating and positioning themselves. Why? Because what happens after that? Yep, it tends to go a leg higher. I waited, and then I started sprinkling in small positions, dollar cost averaging, and waiting for the signal where I can make a bigger move. The second indicator I want you to focus on is the overall direction of the market. We all know the overall and ultimate movement of this market. It can only really go up and to the right based on the conditions. If you agree with that thesis, then everything in between where we are now and where it's going to go is just noise and daily gyrations of the market. So until the trend and or the conditions change, you have to see these pullbacks as buying opportunities. Otherwise, you will end up chasing the market and dollar cost averaging in higher than you really need to. With that, can anyone tell me why the price dropped around $70 over the last 10 days? I mean, really, did the fundamentals of the market change? No. Oh, GDP numbers were lower than expected, and the Fed jawboned about raising interest rates 50 basis points. Who cares in the long term? We know how this movie is going to end. These pullbacks are opportunities. It's why we always keep some dry powder. Which leads me to the third point. As the saying goes, scared money don't make money. And winners don't wait for chances, they take them. While the emotional investors were scared and waiting for gold to come back up before they buy, we, the smart money, were sniping in at these lower prices while we could, buying the dip while keeping premiums as low as possible at the same time. Which then leads me to my fourth point, which is, what is your buying strategy? And what are some of the ways you can work the market? I seriously debated what I'm about to do next, but I feel like it's important that I show you exactly what I've been doing this year in hopes of helping you see my buying style in action and the things I consider when I make a purchase. Plus, it also lets you know that I put my money where my mouth is. On the screen, I have a year-to-date gold chart with gray boxes around my purchases The sad part is that I lost all of this in a boating accident just the other day. That's just in case the feds are listening. So let me walk you through what I've done and my rationale. As a quick aside, if you don't chart every single purchase you make, you're missing an incredible opportunity to use that data to improve your investing. If you've been around, you know I love my spreadsheets. And of course, I use a spreadsheet that documents every single purchase. When I purchased it, what I purchased, the cost, spot price, premium paid in dollars and as a percentage, what percentage of my stack that it represents, and a few other things. If you're interested in seeing my spreadsheet and being able to download a copy, comment and let me know. If there is enough interest, I'll do a video on it and make it available. Back to the chart. Let's start in January. As you can see, I made 2 small purchases to start the year off. And that was just a little bit of a sprinkling. I did that because at the time, it wasn't clear where the market was really going. So I just sprinkled in. When spot went back to the level of my first purchase of the year, I bought a little more aggressively. I made another purchase when spot got close to where I made my second purchase of the year. So I made a couple more purchases. Then I got really lucky. I bought 2 quarter-ounce coins right before the Russian war premium kicked in. We then had a strong run up, so I waited because historically, the markets give it right back or it does a retest. Remember, at the time, we had no idea how long the war was going to last. So I held my water and waited as long as I could for prices to pull back, as I shared. But even then, I only sprinkled in with another 2 quarter-ounce purchases. Why? Because the conditions weren't clear. Would the war end quickly, causing the prices to retreat? How would the gold ruble nonsense impact the market? I had ideas, but again, I don't have a crystal ball. After that purchase, you can see that we bounced around in a tight range. So I made a slightly bigger purchase at the beginning of April. Why? Because in that situation, I interpret the sideways movement as smart money accumulation zone. So I purchased a full ounce when spot was at 1938. I didn't really want to buy a full ounce, not at all, but I had to because SD Bullion was running a special on 1 ounce commemorative coins. This one right here. And it's not even the cutest coin or good looking coin. And it's Mark Twain. I don't care. Because what I care about is it's a 1 ounce coin that SD Bullion was selling for $20 over spot. How many of you saw that sale? If you didn't, I'm going to tell you again what I've shared before. You must create another email account and sign up for every online dealer's email list so that you can scan for deals that are too good to pass up. Again, I paid $20 over spot for 1 ounce, all because I opened an email. I can't stress this enough. Then prices continue to move a little sideways and slightly up a little. And then I sprinkled in a little more. The worst part is I knew I was being a little impatient, but my germitis was flaring up. If you haven't checked out that video, you need to. It's a ton of fun and incredibly informative. At any rate, of course, the price dropped the next day. Sometimes you're the hammer, sometimes you're the nail. What I didn't do was chase the drop. Why? Because as they teach in culinary school, one of the first lessons is you don't try to catch a falling knife. So prices fell down right around 1890, and we got the pullback I had expected, somewhere between 1920 and 1880. So what did I do then? I waited a little while because gold could have easily found support at 1880, or it could have dropped to its 200-day moving average around 1850 to 1835. But heck if I know. So I waited and saw a small update, and then the range tightened and the price drop decelerated. And then I sniped in, as you can see, over the last couple of days. At the risk of sharing too much information, since the 20th, I've purchased 3 1/4 ounces. Not because I intended to buy that much, but I ran across 4 deals that fit my buying strategy. One was a 1 ounce American Gold Eagle at a 4% premium. The second was a special offer from the US Gold Bureau, where they offered me as a new customer a deal. I was able to buy a 1 ounce bar at spot, which was 1908 at that time. A proof 1/4 ounce American Gold Eagle, this one right here, for only $525, which was about $75 below market price at that time. And a 1 ounce Kangaroo for 3% over spot because the dealer let me use my credit card and didn't charge me an additional 4%. And so I used my credit card, which gives me back 2%, which is about $40. Now, before some of you freak out, I do not encourage you buying on a credit card unless you're gonna pay it off in full and only if the numbers make sense. In this case, it did. So while I jumped in at the end of the week, does this mean gold and silver can't fall any further? Of course not. Next week, we have the Fed meeting and a A rate hike, which could have markets react a number of ways. Prices could fall again. Prices could go up with the explanation that the rate hike was already priced into the market. Who knows? If you're finding value in this video, go ahead and hit that subscribe button because Stacker is here to help you get the most medals for your dollars. And I don't want you to miss a single video. Plus, it helps the channel grow and we get to help more people. Also, give yourself and me a thumbs up for taking the next steps towards greater wealth by clicking that thumbs up button and checking out the new animation that comes with it. Just to be clear, I'm not sharing my purchasing details with you to flex or low-key brag. I share this because so many people run their mouths and they never really show you what they're actually doing. More importantly, I want you to see how I view the market, my thought process, my approach, my strategy. Take it or leave it. By no means do I proclaim to be an expert or to suggest that this is the perfect way. What is important to me is that you develop your own buying strategy that you can articulate in a minute or less. So what happens if gold drops next week? Will I be disappointed? Of course, but the alternative of waiting and having gold jump back up to 1950 would really tick me off. I will also share that at some point, I fully suspect that gold will have one last drop down to 1800 when the stock market really tanks and people begin selling stocks indiscriminately. So if I believe that, why do I buy now? If I really believe that it will go back to 1800, I don't know for a fact that will actually occur. What I do know is based on the condition, this pullback was a gift. And I get it. It requires some level of resolve and belief in the conditions for you to jump in and buy after a decent pullback. But most people witnessed this pullback and got scared, got emotional, froze, and totally missed this opportunity. If you're a subscriber to Stackers, I know that didn't happen to you because we are Stackers University and we stack smarter. We don't try to guess what the market is going to do. We have learned and we continue to learn how to see and react when the market gives us the signals. The same type of signals I've shared with you throughout this video and other videos. Answer this question for me. If you were in the market to buy a new refrigerator within the next 3 months or so, and you knew inflation was causing prices to increase, and all of a sudden you saw that refrigerator, the same make and model that you love, and it went on sale, would that spook you out of buying it? Would you say, well, let's wait and see if the price goes lower? Or would you say, honey, jump in the car, let's go. Let's hope they don't sell out. If you don't seize these opportunities, you are basically saying, no, gold and silver market, I don't want to save money. I don't want to lower my dollar cost averaging. I want to wait until I feel safe and everything is at full price, and then I could buy so I can feel nice and safe. It's about the conditions. It's about the behavior of markets. It's about using data to help you make the best decision possible. This is how we stack smarter. This is why I do these videos. Even if you're only able to buy once a month, that doesn't mean you run out the day you get paid and just buy like a drunken sailor on leave. There are a number of variables to consider when you purchase. Here are the things that I consider. Are we at the end of the month? Because prices tend to drop because of money manager and end of the month profit taking. When's the next Fed meeting? What typically happens to prices before or after a Fed meeting? Is there any economic data coming out? How does that data typically impact the prices in general? Have we moved up recently, so is a pullback likely? Or do we have a big run up? I'm waiting for a pullback. What's the premium? Is there a sale or a deal that warrants action now? And those are only some of the top questions that come to my head. Quick shout out to Thought Morton. Second time you've gotten a comment shout out. He wrote, another home run. Professor, don't ever stop with your wisdom, humor, and stories, as they are the coaching that helps to put the facts and knowledge you share into context and helps us to change our thinking so we can become better, more purposeful stackers and savers. Your videos include so many different aspects of learning, coaching, teaching fundamentals, psychology, positive thinking, and sound real money advice. I look forward to every new upload you post. Thank you, my friend. I appreciate it. That's what this is about. That's why if you haven't subscribed to Stackers, you need to. Back to our topic. I want you to be actively learning every day, developing an investor's mentality. Dare I say a stacker's mentality? I don't want you to anticipate the market, especially over the short term. I want us to learn to react and or act when the market gives us the signals. Remember, over the next few years, we're going to experience a tremendous wealth transfer. And people like you and me often get the short end of this stick during these times. I want you to continue to invest in you and your knowledge so you can have the tools to seize these moments so you can take your shots when the door opens. So the next time there's a pullback and I ask the question whether or not you bought the dip, the only two acceptable responses are: one, I didn't because it didn't fit into my budget, or two, are you knuckin' futz? Of course I did. I love buying metals when they are on sale. Thank you for seeing this video all the way through. You're my A students. I hope you received tremendous value from this video. In the comments, please share what conditions you think are most important when it comes to evaluating where gold and silver is going and why. Also, feel free to ask any questions as I respond to all comments. Always stack smarter and never stop learning.